When you say you have an exceptionally difficult year, is that to set us up for a much better and stronger 2018, Inga?
Well, Lloyd's is in the insurance business, and we're here to pay out when things go wrong. And last year was one of the costliest natural catastrophe years for the last decade, and that was what put the market into a loss. It's very, very difficult to predict when those catastrophes are going to happen, so it's not something that we can predict for 2018 at all. We can quantify potentially what the exposures are, but not when some of these events are going to happen. But I'm really pleased to say that Lloyd's has sort of stepped up. It's shown what it does best, which is put people back on their feet when disaster strikes, whether it's businesses, communities, or indeed all those individuals whose businesses rely on being able to be up and running even throughout the worst disasters.
Inga Beale, good morning. Guy Johnson. You talk about it being a bad year. I think it was the first time in 6 years that the market has posted a loss. But talk to me about the trend that underlies that. Are we seeing more natural disasters coming through? Do you expect greater volatility in earnings as a result of more of those natural disasters sort of occurring? The trend line certainly seems to point towards it.
Yeah, so we paid out for large claims £4.5 billion last year, net of reinsurance. And that's a significant number. I mean, that was more than double in 2016. We're seeing the impact of climate change to a certain extent, particularly on these weather losses. With the rising sea level, that impacts and increases the amount of loss. With the rising sea temperature, that increases the frequency and likelihood of some of these hurricanes hitting land. And that is absolutely driving an increased frequency and cost of natural catastrophes like that. But we've also got other catastrophes that are happening around the world. You've got earthquakes, and they're, again, very unpredictable. So it's always difficult to look at that sort of volatile side of insurance. But we've also got many other lines of business and products out there that are not related necessarily to climate change. Now, one of the biggest increasing risks for all businesses is technology and the risk of being attacked. Or perhaps losing data, affecting customers. So we're seeing actually some growth in new areas. One is demand for cyber insurance. We're also seeing the sharing economy really taking off in various markets in the world, and we're offering products for the sharing economy. We're seeing political uncertainty all over the world, and we're seeing a greater demand for political risk insurance. So there's lots going on out there and lots of new things that Lloyd's can look at, but we mustn't shy away from the fact that some of the underlying portfolios aren't all making good underwriting profits for insurers either. And that's because of the pressure. Capital has flooded into the market and it's put pressure on pricing.
Well, I wonder what you do with the capital that you have. Can you make more money on it this year in a rising rate environment? Does that make it a little bit easier, or does the rising volatility kind of push back against that for returns, Inga?
Well, yeah, so returns, we've got two elements of it. We've got the actual underwriting result, and we did see pressure on pricing ease off in the fourth quarter following some of those natural disasters. But what we also saw for the Lloyd's market was actually an increase in investment return. So we've got the other side of the balance sheet, which is where we're investing the assets, investing that premium, and we're making a return on that. And that actually, we saw a better return. And that was mainly through our equity portfolio. We've got equities are about 14% of the market investment portfolio, and we saw a better return in that segment than we had the previous year. So we've got two sides. We've got to get the pricing correct on the underwriting and the liability side, and we've also got the asset and the investment side that we can use.
Inga Beale, just a couple of quick questions kind of related to Brexit. In terms of the Brussels move, you're applying for a licence there. How many operations go there? What goes there? Where does that leave London?
About 11% of Lloyd's overall global revenues are from the EU 27 markets. It's about €4 billion. We want to make sure that we can still continue to serve all of those customers. Therefore, we're setting up a Brussels subsidiary. We should get the authorisation in the middle of this year and have that all operational for the 1st of January 2019, so ahead of Brexit. We won't, though, have to move that many people and jobs there. We're anticipating about 40 people will be based in Brussels. And a lot of the activity that used to traditionally take place in London will be able to continue to take place in London. So the actual job impact isn't that great, but we have to set up a subsidiary, put capital in there, and importantly, have that as the licensed entity to continue to offer insurance for our clients.
What is your view on the transition deal that is being struck? Is it too little, too late? Is it enough? Does it still provide a great deal of uncertainty, given the fact that the EU is saying that nothing's decided until everything is decided?
It gives us a bit more time to sort out some of the old sort of legacy issues that we've got to contend with. So while Lloyd's and other insurers and banks are solving for business on an ongoing basis, we've got, as an insurance market, there are policies that are still out there that need to be serviced. And we lose the licensing and the ability to service those policies on Brexit. The transition period gives us longer to solve that issue. Now, there has to be, in our view, some resolution on this across in the entire European region. You've got policyholders and customers in the EU 27 and in the UK that could potentially be negatively affected by this. And we believe that the regulators across Europe can actually come to an agreement themselves and find a possibility for actually allowing all of the insurers and banks, both sides, to actually continue to service those old contracts. And that's what we're really pushing forward, to give contract continuity, that grandfathering, that ability to service those old policies.